$17 trillion in purchasing power vanished. When the credit cycle broke back then, paper assets plunged 90%, 10,000 vaults locked forever. 1 in 4 workers stood in bread lines. A whole generation watched their savings evaporate into thin air. They call it the ultimate deflationary bust. But stackers know the truth regarding 2026. We are not facing a simple repeat of that history. This event is far uglier. Not just emotionally painful, it is mathematically fatal, systemically broken. Currently, total debt saturating the U.S. fiat system is 98 trillion Federal Reserve notes. That sum combines sovereign, corporate, consumer, and banking sector liabilities. In 1929, total debt adjusted for real inflation was roughly $290 billion. This implies the Ponzi now bears more than 300 times the leverage load that existed when the Great Depression began. However, massive scale is just one risk factor. In 1929, counterparty risks were local. A bank run in one region didn't immediately vaporize wealth nationwide. Today, the entire grid is entangled. High-frequency trading derivatives, global fiat flows, and margin debt have welded the market into one fragile block. If one link snaps, the contagion infects the whole system instantly. More importantly, this time the crash isn't sector-specific. Equities, treasuries, housing, and the dollar itself are buckling under pressure together. There is no sector rotation, no fiat sanctuary, no paper asset safe from the rot. This isn't a collapse looming on the horizon. It is a meltdown that is already active. Throughout history, every fiat currency failure followed the exact same 4-stage cycle, without exception. Coming up, I will deconstruct that roadmap and pinpoint our current coordinate. This isn't speculation, it is cold math. And once you grasp the mechanics, you'll see why 2026 isn't just a red flag. It is the instant the Ponzi is finally exposed. Drop a 1 to proceed, or a 2 to end it here, and smash subscribe if you need to know what happens next. To see why the crash is baked in the cake, you must grasp the machine. Currency collapses aren't accidents. They aren't black swans. They don't rely on politicians, bankers, or policies. They obey a rigid mathematical progression that has replayed throughout the ages with absolute mechanical certainty. 4 phases. Always the exact same sequence. Always the exact same tragic ending. Stage 1 is the sound foundation. This is the phase every honest economy begins with. Prosperity is driven by productivity, innovation, real output, and sound money. Debt exists, but it plays a supporting role. Credit, funds, farms, factories, infrastructure, and businesses that create real returns. Income grows faster than the paper notes. This is true wealth creation. The system earns its expansion. Stage 2 is the expansion. Credit becomes cheap. Lending standards loosen. Debt starts to grow faster than the actual economy. At first, this feels like prosperity. Asset prices rise. Stocks climb. Real estate appreciates. Folks feel wealthier and borrow against those rising values. Banks lend more because collateral appears stronger. The feedback loop forms. Higher prices justify more debt, and more debt drives prices higher. This phase becomes politically and economically addictive. Bankers profit from loan volume. Speculators profit from asset inflation. The state collects more tax revenue from transactions and capital gains. Entire sectors form around finance gambling and leverage. At this point, stopping the credit expansion becomes impossible. The system itself now depends on exponential debt to function. The danger is masked during this phase because nothing appears broken. But the gap between what is owed and what can realistically be repaid keeps widening. Debt is no longer funding production. It is funding price inflation. The economy begins to consume its future growth to support the present illusion of endless prosperity. This is the most deceptive stage of the cycle. It convinces intelligent people that the system is healthy precisely when it is becoming fragile. And once expansion reaches its limit, the shift to the next stage is not gradual. It is absolutely abrupt. Stage 3 is where illusion collides with reality. This is the trigger phase, and it is the most misunderstood part of every debt crisis. People assume the collapse is caused by a single event, a policy mistake, a war, or a shock. That belief is wrong. The trigger is never the cause. It is merely the moment the system can no longer roll over the massive debt. At this stage, something small breaks the cycle of expansion. It can be a hike in interest rates, a regulatory shift, a loss of confidence, or a foreign disturbance. The spark itself is irrelevant. What matters is the timing. The weakest borrowers suddenly cannot refinance old debt with new debt. Defaults begin quietly, often in corners. No one is watching. Since the system is heavily leveraged, those small failures do not remain isolated. Asset prices stop rising. Then they flatten. Then they fall. As prices crash, collateral values decline. When collateral shrinks, lenders pull back. Loans are not renewed. Credit lines are reduced. Borrowers are forced to sell their assets to raise cash. This is where the feedback loop reverses. Forced selling pushes prices lower. Lower prices trigger margin calls. Margin calls force more selling. Liquidity evaporates. The same mechanism that amplified gains during expansion now amplifies losses during contraction. Greed is replaced by fear. Lending is replaced by hoarding. Trust totally disappears. Here's the critical insight most people miss. The debt does not vanish. Every dollar of debt is someone else's asset. When borrowers default, lenders absorb the loss. When lenders take losses, they cut credit. When credit contracts, the economy shrinks. Shrinking income leads to more defaults. The loop feeds upon itself. Once this phase begins, policy tools lose their power. Central banks can inject liquidity, but they cannot force lending. Governments can stimulate, but they cannot restore solvency. The system is no longer expanding, it is deleveraging. And deleveraging will always accelerate. This stage feels chaotic, but it is not random. It is the inevitable result of too much debt built on inflated prices. And once the trigger phase is fully engaged, there is only one stage remaining. Stage 4 is the part history remembers, but only after it has already passed. This is the destruction phase, when the system resets itself by force. Debts that cannot be repaid are eliminated either through default inflation or a combination of both. Asset prices collapse until they reflect real economic output rather than leveraged expectations. Wealth does not disappear evenly, it just concentrates. Those holding paper claims tied to inflated values are wiped out. Stocks priced for perpetual growth, bonds priced for stability that never existed, and real estate bought with excessive leverage all reprice violently. The middle class, whose savings are concentrated in these assets, absorbs the majority of the damage. This is not punishment. It is just mechanics. Cash flow dries up. Businesses fail. Unemployment surges. Governments face collapsing tax revenues just as social support demands explode. Social tension rises because economic pain always manifests politically. Trust in institutions erodes. People search for someone to blame, but the process itself is indifferent to your narratives. At the same time, a transfer occurs. Those who held liquidity, real assets, or claims outside the inflated system gain relative power. They acquire assets at fractions of previous prices. This is how wealth consolidates after every major debt reset. Not through conspiracy, but through smart positioning. Eventually, after enough destruction, the system stabilizes. Debt levels fall, prices normalize, productivity slowly rebuilds. A new foundation forms and the cycle begins again because human behavior does not change. Confidence returns, memory fades, leverage soon reappears. Every major collapse in history has followed this exact four-stage structure. Foundation, expansion, trigger, destruction, different centuries, different currencies, different technologies, identical outcomes. The names change, however the math does not. Understanding the sequence is not about fear, it is about clarity. If you can identify the stage, you can understand what actions make sense and which ones are suicidal. And to see how precise this pattern really is, we now need to look backward at history and compare it point by point now. The Great Depression is certainly no mystery. It is the most clear financial collapse in the books, and it followed the four-stage pattern with exact precision. Stage 1 was the post-World War I foundation. The United States emerged as an industrial powerhouse. Productivity surged, manufacturing expanded, real economic growth supported rising incomes. That foundation was truly legitimate. Stage 2 arrived in the late 1920s. Credit exploded. Margin debt allowed investors to buy stocks with as little as 10% down. Asset prices disconnected from reality. From 1925 to 1929, stock prices tripled while earnings lagged behind. Price-to-earnings ratios climbed above historical norms. Speculation replaced investment. Florida real estate boomed. Get-rich-quick schemes flourished. Debt accumulated quietly beneath the surface here. Stage 3 was triggered in October 1929. As stock prices slipped, brokers issued margin calls. Investors had no cash. They owned stocks purchased with borrowed money. To raise cash, they sold assets. Selling pushed prices lower, triggering more margin calls and more forced selling. Within days, panic spread. Liquidity vanished. The feedback loop turned truly